What is up, everybody? My name is Ryder Schilling and I love options. Today I'm going to teach you everything you need to know about options, how to get started in the options world to make some money. Now, did you know in the stock market there's over $18 billion traded every single day? That's right, $18 billion. That is a lot of money, and with options you can get your share of that money. But in order to do that, you have to understand what they are. So if you aren't subscribed already, get subscribed, because if you aren't going to learn anything in this video. Just kidding. You probably will learn stuff, I hope you do, but subscribing would definitely help the channel. So what are options? This is a question I get asked all the time, and when I started I had the exact same question, so I'm going to break it down for you. Options are stock derivatives, which means that they go based off of the stock that is underlying. Underlying means, say you have Tesla as your stock, a Tesla option would be your derivative, Tesla would be the underlying because it's a stock that's being traded. So options are derivatives, which mean they go based on the stock's price, but depending on which one you choose and the metrics chosen, it'll perform differently based on the performance of the stock. Now, where options differ from stocks is instead of buying shares, which you would be if you were buying stock, you'd be buying contracts in options. So you buy the option contracts. A contract gives you the right to buy 100 shares at the price you selected. So you pay a premium up front, and you get the contract that says, hey, if this price goes above the strike price I select, I have the option to buy it at the strike price selected. For example, say we have a house, it is retailed for $100,000, but you don't want to buy it at $100,000. Let's say you write an option contract, say I'll pay you $1,000 up front for the option to buy the house at $100,000. If the price of the house goes up to $105,000, you can choose to exercise the contract. So you would pay them $100,000 plus the $1,000 in premium. So essentially, you own the house at $101,000, and you can sell it for $105,000 for a 4% return. That's pretty good, and it also limits your risk, because say the house goes down and you only own the option contract, you don't have to exercise it. So it limits your risk. Plus, it gives you upside potential, and that's what options are. They leverage and they hedge. Now, to truly understand options, you have to know where they came from. So options were originally used in the stock market in 1973. That's when they originally came out. So they've only been around for about 50 years or so, but they've been widely used since then. They first came out to actually hedge your positions. That's what they were originally meant to do, and that's all they were for, was just to hedge. Lately, a lot of people have started using them to leverage capital and positions to make more money, which is a lot of fun, and it's a great way to use them. It is a little bit more risky, but remember, they were always originally invented for hedging, and that's what they still are. They are a great hedge to your portfolio, to your account, and to your positions. Now, for those of you who don't know what hedging is basically a fancy term to describe how you protect your downside. So hedging protects your account if it were to go down. Options are a great way to hedge your risk. At first glance at options, it can be so confusing, and that was the same boat I was in. I was so confused when I first saw them and heard about them. You can buy calls, sell calls, buy the puts, sell the puts, buy the spread. You can do all this kinds of crazy stuff. And it's very confusing at first, but let me tell you, once you understand it, once it clicks, it is so easy and you'll understand it so well, and it'll just be a game changer. So the easiest way I learned how to understand options in the basic 4 ways you can trade options is to use what I call is an option box. This is what it looks like. Now, this box might seem confusing at first, but hang with me, I'm going to break it down for you so you understand it very well. We have calls and puts. Call is when you say the stock's going to go up. Put is if you're going to say the stock's going to go down. So buying the call, if the stock goes up in your favor, you make money. Now, if you buy a put and the stock goes down, that's good because you make money, because you bet basically that it would go down, and it did. Now, on the top, we have the buyer and the seller, also known as the holder or the writer. But you don't really need to know those terms. All you need to know is the buying and the selling. Now, within these boxes, we have rights and obligations. Now, When you buy an option, you're always given the right, because if I were to buy that house like earlier, I buy the contract for $1,000 and it gives me the right to buy it at $100,000 if the house were to appreciate. Now I don't have to use that option, but I do have the right if I were to exercise it. Now, if I was selling it, say I was a homeowner and I was to sell this contract, I'm given the obligation that if the buyer exercises the contract, I have to sell the house at $100,000 to him. It's just as simple as that. It's just what you agree to in the beginning, but you have rights and obligations. Rights are always for buying, obligations are always for selling. Now let's go over the call section. Now back to the house example. Since I buy the contract, I technically buy a call. It's the same thing in the stock market. I'm just buying the call, I'm buying the contract, giving me the right to buy the house at the agreed upon price, which is $100,000 in this case. Now if that were stocks, say that's Apple for example, and Apple's at $200 a share, and you buy a call and the call is at, let's say a strike is 190, you're given the right to buy it at 190. If Apple goes up, you're given the right to buy it and you make money. Or you don't have to exercise it. Say it goes down, it limits your risk, and all you spent was the premium paid when you bought the contract. Premium is what is paid or received. That's basically the cost of the contract, is just called a premium. So whenever I say premium, it just means the cost of the contract. But when you buy a call, you are having to give the premium to the seller in order to receive the contract. Now buying puts work the exact same way, but instead of a right to buy the shares, or let's go back to the house scenario, buy the house for $100,000, you are given the right to sell the shares at $100,000 or the house at $100,000. So let's say Apple again is $200 a share, and you buy the put, and let's say it's 190 like the previous example, gives me the right to sell shares at 190. So let's say the stock price is at 200 and it drops to 185. I can exercise the contract, buy the shares at 185 and sell them at 190. Again, remember, we were given the right to sell the shares at the strike price. The strike price was 190, stock fell, so we can buy the shares at market value and sell them at the strike price we selected on the put contract. Now let's go to the selling side. Remember, when you're selling a contract, you are given the obligation to follow up on the contract you agreed on. So let's say I was a homeowner and the buyer decides to exercise the contract. Remember, they have the right to exercise it. When they do, we are obligated to either sell or buy the shares at the agreed upon price, which is the strike price. So selling calls is a great way to actually make income on shares you already own. Now for selling calls, you have to have collateral. Collateral is the money or shares required as backup. Most brokerages won't allow you to sell naked calls or puts, which is basically no collateral. So you need collateral to do this, which can be quite expensive. Collateral for buying calls is 100 shares of the underlying stock. So let's say Apple's 200. You would have to own 100 shares of Apple at $200 a share. Now for some of you that might seem outrageous. That's what, $20,000? That's insane. But don't worry, there's cheaper stocks to do it on. I do this all the time, and I have a somewhat small account, or at least at one point I did, and I would do the same thing. But it's a great way to create passive income while allowing your shares of stock to appreciate in value at the same time. Now remember, when selling a call, I own the 100 shares. I basically rent them out to the buyer. So let's say I have 100 shares at $200 a share of Apple. Let's say I want to sell someone else the right to buy those shares at the strike price agreed upon. That means we would have to sell them at the strike price. Now always make sure when you're selling calls to make your strike price that you're selling at above the price that you own the shares at. Let's say Apple's at 200. Always make sure the strike price you're selling them at is above 200. If not, you could lose money if it goes down. You may collect more premium, but I don't think it's worth it in the long run. Now, in the case that your shares do get exercised and picked up, don't worry, this isn't a bad thing. you actually make money on this, and it's no problem at all because you make the premium. Remember, you collected the premium when someone else bought your shares, and you will make the difference in, say, Apple's 200, it goes to 205 where your strike price is. You'll make the difference, which is $5 a share. So you're making money and collecting the premium. So this is not a bad thing unless you want to keep your shares. But then again, you're still making money. You can't complain with that. It's not too bad. Sometimes it will cut your costs at the top. Say it goes like to 230, makes a huge jump or something. Yes, you miss out on some gains, but you guaranteed money in your pocket, and that's never a bad thing. Now let's go to selling puts. Selling puts are typically viewed as a risky strategy. It can be confusing at first as well, so I don't suggest doing them at first. I don't do these a whole lot. Let's go over it just so you understand it. Now, selling put gives us the obligation to buy shares at the strike price selected. So when you do this, you have to have collateral to buy the shares, 100 shares, at the strike price. So let's say Apple is $200 a share. You say, hey, I might want to buy this at 190. If it drops to 190, I'll buy it. But instead of just waiting for it to drop down, you could sell a put, so you're collecting premium, waiting for the stock to drop. Once it drops, the buyer would exercise their right to sell shares at that price, and you will have to buy them at that price. So you have the money, the collateral, to do that, so no problem at all. You already have that set aside. You own the shares at what you wanted, and you collected premium, which cuts down your overall cost on your shares. Now, obviously, this is a beginner's video targeted towards people that maybe haven't done this before. So if that's you, what I want you to do is just start off with buying calls. It's the easiest way to use calls. It's the simplest to understand, and it's the backbone of everything we do in options. Now, in order to truly understand how call options work, I'm going to show you how stocks work on a graph, on a profit loss diagram, and I'll show you what options do to alter your profit and your loss. Now, here we are in the little diagram I made up here. So let's say the stock price is 100. So stock price is right here. If the stock price goes up, our profit goes up. If the stock price goes down, our profit goes down. Now, if the stock price goes up $1, we make $1, up $2, we make $2, all the way to infinity and beyond. Now, if the stock price goes to 0, we can also lose all of our money. Now, what's nice about call options is you only lose as much as you invest, but it's much cheaper than stocks. So you don't need as much capital to get in originally, and you can make just as much, if not way more. Now, let's say a call option on this stock at $100 was $2. The contract was $2. So if that's the case, our max loss would be $2 right here. Let's draw that out right there. Perfect. Now our max loss is $2, but it gains everything on the upside. There is no upside cap on them. So right here, we cut our maximum loss at $2 while still holding out for max profit up top. Even if it moves a little bit, we can sell out. You can buy and sell the contract. You don't have to always exercise options. That's the beauty of them, and that's usually how most people trade options. I think only about 20% of the options market actually exercises contracts. So 80% of option traders always just buy and sell the contracts. Buying and selling the contracts work the same as if you were to buy and sell a stock. If you buy it and the contract goes up, you can sell it for what the contract's worth and make the difference. Say you buy the contract, in this case, for $2, and it goes up, and let's say now the contract's worth $4. You can sell it and make 50% profit, which is pretty good, and you don't have to deal with the shares of stock at all, and all you needed was $2. Now let's jump into my favorite brokerage platform, Robinhood. I'm going to show you exactly how I buy calls when trading options. So here we are in Robinhood. I'm on Apple. I'm only on Apple because it's just a very popular stock, and I do like Apple a lot. But I'm just going to use it as an example today. I'm not going to actually place any trades, but just go along with it and see how I do it if I were to place a trade. So let's hit trade down here in the bottom right corner and hit trade options. All right, so I'm going to break this down for you so you understand each part of this, because this can look very confusing. but trust me, it's very easy. First things first, if you tap the top left and hit builder right here, this is a simple way, especially if you're starting to select the strategy you're trying to do, and it does simplify it a little bit. I never use this personally, I never have, just because I like having the flexibility of just going to my expiration date and customizing it. But say you were to buy a call, it's called a long call. When you're buying, you are long the position. If you're buying stock, you're a long stock. Now if you're selling, you are short. So if you were to sell the calls, it would be covered call or short calls because you're selling them. Now, so right here we have long call. Right top left here says bullish. It just has a single green dot. And like we drew out before, there's your max loss and you have your max profit going up to the right. So if I were to tap that, it would take me to all these contracts here. Now I still have to select an expiration date here. All I have to do is tap a contract and it'll automatically just fill it out. And I'm just able to buy it right there, which is pretty slick. But for me, I like being very customizable with what I'm doing. So for me, as soon as I go into the trade options category, I always select the expiration date based on the strategy I'm wanting to do. Am I doing it short term? Am I going long term? Is this a day trade? Is this a swing trade? Is this a leap? Now, all those might seem confusing to you at first, but don't worry, they're very simple. If you subscribe to the channel, I'll teach you each one of them and how you can make money doing it. But for now, I'm just gonna go a month out, because month, especially for new traders, I'm gonna explain this very quickly. There's a Greek called theta, it's called time decay. So it eats away your contract every single day. Now, time decay increases on the last 30 days of the contract and doubles in the last week. So your line might go like this in time decay, but in the last 30 days it's gonna drop like that, and then the last week it's gonna go straight down basically. So what you wanna do is go at least 30 days out to give you a little bit of time before the contract really starts getting eaten into. Now, there are 4 tabs up top, and this is how you can build your strategy. Like we explained before, this is the options box. So you have a buy and you have your sell right here. So what we're doing is we're buying a call. Now, once you're on the buying call strategy, there's a couple things you do need to know, and that is called moneyness. Moneyness is simply broken into 3 categories. You have at the money, out of the money, and in the money. At the money is where the stock price is now. As you see, there's this little line going across my chart that says share price 212.18. It's changing pretty frequently, but that's where the stock is right now. So the 2 call options, the 12.15 call right here and the 210, those are both at the money because they are the closest to the share price. Everything above those up here now is called out of the money. So they have no intrinsic value and they will expire worthless at expiration. Everything in the money or below the strike price has a lot of intrinsic value and barely any extrinsic value, meaning it won't expire worthless. It'll be basically worth the intrinsic value. These have immediate benefit because they're already below the share price. So I could buy this and exercise this right now and my shares would be worth something. Say I were to buy the $200 call right here. The $200 call would already be worth $11 and basically $12. And that's all I have to do is just buy it and exercise it. Now, the premium that I pay for this call will be more than what the difference is in the stock. So the difference between if I were to exercise it, the strike and the share price was $12. But as you see, the premium that I have to pay is $15.75. That's $3.75 more than the difference between my strike and the share price. So it wouldn't be any benefit to me to actually buy this and exercise it immediately. But those are the 3 parts of the contract that you need to know. And again, there's a lot of different ways you can do this. There's benefits and disadvantages to anything you do here. It just depends on your own risk tolerance and what you're wanting to get out of the contract. But then again, subscribe to the channel. I'll teach you each one of these strategies individually, break them down so you know what you're doing. I don't want you going out there losing money. I want you to be very well prepared for trading options. unlike I was, unfortunately. But I'm here to teach you guys exactly everything I did wrong so you don't do it. But for now, I'll show you how to fill out a trade and so you don't lose money, because there are a couple things that I do here that all options traders do so that they are getting the most out of the contract they're buying. For starters, what I always do is I would go out of the money and find the closest contract with a delta of 0.30. The closest contract to that still has volume and open interest, which means people are buying it. If it has high volume, means a lot of people are buying it today. If it has high open interest, that means a lot of contracts are open right now. So this one here, I see a 0.26 delta, and I see a 0.36. I think the 0.26 is going to be closer, and it still has a lot of volume. It has 2,300 people that bought it just today, so that's pretty good. So I'm going to tap that here. I can see all the metrics of it, the Greeks, volume, open interest, implied volatility. I can see all that stuff right here. Breaks it down really simply for me. And so if this is the one I want to buy, all I have to do is hit buy. And then up top, there's 3 different categories. Up top is the first one. This tells you how many contracts you're gonna buy. Let's say I wanna buy 3 of these. I'd type in a 3. If I wanna buy 1, it's already filled out as a 1. I can just tap here and it would just buy 1. The second column is the price that you're gonna pay for it. So right here we see a bid and the ask price. Now there's a 2-cent difference between the bid and the ask. Normally the contract will be traded right in between those. So right here it's changing quite a bit because we are in market hours, but I see, I don't know, a 3-cent gap right here. So what I'm gonna do is I'm gonna type in, now I already have my thing set to find the mark price, which is what the bid and the ask, the middle of those is a mark price. Mine's already set to buy contract at the mark price. So I don't really have to hit anything. All I have to hit is just review and buy. For new people, I just want to make sure that you are getting it at the mark price. So always type in your own price in between the bid and the ask, because if you don't, you will automatically be down on the contract, which is never fun. Now there's another tab here. As you see right above review, there's a little like green arrow that you can tap right there. So as soon as I tap it, it shows my profit and my loss, and it shows a diagram there. So as we already laid out before, here's the max loss, which we drew out, and then everything to the right is unlimited profit. That could go, you know, up to millions of dollars. It doesn't matter. There is no cap to that. Now you guys know what options are. Thank you so much for watching. I really appreciate it. Now, if you want to see more and learn more about option strategies, and how to utilize them to make more money, definitely hit the subscribe button down below and be notified on any new videos that I make, because I will be coming out with a lot more in the future. Now, thank you guys for watching. I'll see you on the next video.